YNABers. My name is Jesse Meekum, and this is podcast number 351 for YNAB, where we teach you 4 rules to help you stop living paycheck to paycheck, get out of debt, and save more money. I was strolling past the business section of the New York Times on Caitlin's desk here at the YNAB HQ, and this little blurb said, how to time this market. And it was a little blurb for a column that was buried inside. And I thought, that's a stupid name or stupid little hook to get people. But it does. It's just so alluring. You don't time a market. If you did do it right, you got lucky. And if you didn't do it right, you're like most people. So when people talk about timing the market, they're talking about buying low and then riding that market high and then somehow knowing when to sell as well. You have to be right twice. You have to be right in that you bought early, or I should say bought early. You bought at the right time when prices were low, whatever that may be. And then you also sold at the right time when prices were high, whenever that may be. So you have to be right twice. It's hard to be right one time. However, if you just continually buy into the market, and I mean broadly the market. When I say the market, I mean you're buying a fund that invests in the total stock market available. There's Vanguard's fund, every major fund house has these total stock market funds. And you buy into those. If you've read my friend Jim Collins' book, The Simple Path to Wealth, you will be very familiar with this idea. But you're just always buying. And that way you're right a lot of the time because you're just always in the market. Now, you don't sell ever because selling means that you've incurred transactional costs. It means you've incurred capital gains taxes. And I was going to say, unless you're in a tax-free account, which may be the case. But then you just got to buy again something else. So when you sell, you're kind of saying, well, what am I going to buy next? When people talk about timing the market, they're talking about, again, buying at a point where it's low relative to where it will be in the future. So then the market goes up, and then they sell at some point, and they make their gain. And then what do they do with the money? What do they do with it? Do they stick it in cash? Do they just hold on to it, put it under their mattress? So they still have this. You still have this question to answer of where will the money go now? If you're wanting to upgrade your home, you say, oh, we're going to buy a new home, and you sell your home, and you've been in a real estate market where it's been rising over the last 6 years or so. Then you just move laterally across to a new home. You haven't really made any gains. You just kind of made this lateral move, and then you're in a bigger home now, and you'll have larger property taxes and more to clean and all that jazz. So have you actually made the right move? No one knows. If the real estate market goes down, you actually have more exposure now because you're in a bigger home, and maybe it wasn't a good thing. Maybe it's smarter to be in as small a property as possible, to not expose yourself to as much undiversified risk. I don't know. But the idea of being able to time it and guess when's the right time to get in and when the right time is to get out, you don't do that. You just dollar cost average. You can Google it if you're curious what it means. I think most of you probably know, but it's basically that you buy, just always buy, always buy, always buy, and never sell. And when the market goes down, you just keep buying. And when the market goes down further, you just keep buying. And you've lost money. I do that in air quotes. You've had unrealized gains for some of the stuff that you bought early and then the market went down, but you just keep buying anyway. And over time, as the market rises, over sometimes a long period of time, over time, as the market rises, you end up making gains. And you participate as an owner in the entire economy, where you own all the businesses. And you just get to participate as the economy grows. And sometimes the economy stagnates. Sometimes people aren't super predisposed to purchase stocks, and so you see the price depressed then. Sometimes people are downright afraid. Other times they're euphoric about stocks, and you're seeing big run-ups. Don't worry about any of it. Just keep throwing money into the market and become a larger and larger owner of the entire economy, and then go off and do whatever else you want to do, but don't pay attention to it. And for my word, do not try and time anything. The greatest investor of all time, Warren Buffett, said that most investors would be well served to simply buy and hold an index fund forever. An index fund is a very, very, very simple investing mechanism that means you've basically purchased the whole market. Don't try and time the market. If you see yourself saying, gosh, I've got this windfall. Should I invest it now because the market seems really high? You're timing the market because you're not getting in. If you're sitting there and you're looking at big unrealized gains from all of the buying you've been doing over the last 5 years, and now you're saying, ooh, should I sell because this looks like it's going to be high? Don't do that. Just keep buying. Keep buying. You only sell when you want to start actually using those funds for your retirement expenses. So just buy, hold, and pay attention to other things, like the NFL or something. Until next time, follow YNAB's 4 rules and you will win financially. You've never budgeted like this.